All right, hello, welcome back into the Netpicks Options Academy. In this week's options trade of the week, we're going to take a look at symbol NVDA, which is Nvidia. We've had just a phenomenal stretch to the upside on many of these tech names. A lot of these names have continued to make new all-time highs on a regular basis. You go down through the list, whether it be Apple, Amazon, Netflix, and Tesla, even though they're not at the highs, they've been very active. We've seen a lot of activity in many of these tech names. So looking at Nvidia, it's had an impressive run to the upside just over the past couple of weeks. You can see this move higher here at the top of the chart. We've basically gone from down below 240 back at the beginning of August. We've already made it up to almost 282. Okay, there's a $40 move to the upside with hardly even a glimpse of a pause. As a result, the market is very overbought. Now, I get questions on this all the time. How do I tell if something's overbought? I could just look at this chart and assume, hey, after a $40 move to the upside, it's overdone. But is there any way that I can take a look at an indicator or any type of statistic that's going to back up that outlook? The bottom line is overbought can stay overbought longer than any of us expect. So is there any way that I can take a closer peek at this and have some data to back up that we are nearing an extreme on the upside? One of our custom indicators that we've created at Netpicks is the red and yellow histogram down at the bottom. It's what we call our pulse indicator. Some of you that have been longtime traders, you're familiar with standard deviation channels. Those are channels that you can put on your chart to tell you whether price is at an extreme or not. And what I have done in the past is I've put standard deviation channels on my chart representing 1, 2, and 3 standard deviation moves. When you start to hit those channels, in many cases, price action will start to get tired. You're going to start to see either a pause or a reversal off of those channels. Well, instead of having those channels on my chart, because I like my charts as clean as they can possibly be. I don't like to look at a dozen different indicators. I don't like to look at a lot of trend lines on my charts because I want to be able to come in and make a quick decision on whether there's a trade there or not. And if there is a trade, I want to know where to get in and where to get out as quickly as possible. What we did with the pulse indicator is we color coded where price action is at relative to where the standard deviation channels are at. If you have a series of red bars, which you can see down at the bottom of the chart, we had it here just last week. Those red bars represent price action being stuck between the midline and the first standard deviation channel on the chart. Oftentimes when you see red bars, in most cases, you're going to see price action indecisive. You're going to see a period of consolidation starting to kick in. If you start to see the yellow bars, which you can see here just this week, we had a whole slew of yellow bars there. That tells us that the current price action on the chart is in between the 1 and the 2 standard deviation channel. You don't see it here on the chart, but you'll actually from time to time see green bars pop up on that pulse indicator, and that represents a move between the 2 and the 3 standard deviation channel. In this case, because we have the yellow bars, we are approaching a 2 standard deviation move on the upside. What that means, it doesn't mean that price action has to immediately stall out and head lower. What it tells us, and when we start to approach a 2 standard deviation channel on the upside, the chances of that move continuing at the pace that it has gone to the upside, the chances of that happening are pretty slim. With that in mind, again, it doesn't guarantee a move lower, but I want to position myself with a trade that could potentially benefit from a slowdown. Whether that be a period of consolidation or even an immediate reversal to the downside, it does not matter to me. There's money to be made from an extreme. So again, I'm using the pulse indicator to identify this extreme on the upside. It is an extreme because we are approaching the 2nd standard deviation channel on the chart, and I can see that by having the yellow bars down at the bottom. The minimum that I like to see for me to be intrigued by a trade, I want to have 3 out of the past 5 bars on that pulse indicator showing up as yellow. Well, we have that. In fact, we have the past, 8 bars showing up as yellow. That's telling me that we're nearing a point of exhaustion on the upside. My takeaway from that is I want to potentially put on a trade that would benefit from a period of consolidation or even a pullback to the downside. Oftentimes people think if the market's overbought and you're expecting a reversal, the best route to go is just to buy an outright put. Buy a put option and benefit from a move to the downside. The problem that I have with that trade is if you buy a put, the only way you make money is if that stock makes a big move lower, and it does so quickly. Because the moment you buy an option, the time decay is hurting you. If that trade takes too long, the time decay is going to crush any profit potential that you have. So instead of buying a put, I still want to position myself neutral to slightly bearish, but instead of buying a put, I'm going to take a look at selling a call spread. Selling a call spread, it's going to give me 5 different ways of making money on the trade, which you'll see in a moment. I don't have the home run profit potential, but in exchange, I have the higher probability of success. So let's jump over to the trade page and let's take a look at selling a call spread on Nvidia. What I'm going to do is take a look at the September 14 weekly options. They have 14 days left. Why am I going with the weekly options here? By going with those weeklies with 14 days left, the closer we get to expiration, the more the time decay picks up. That's a good thing. When I sell a credit spread, I want that time decay to add up as quickly as possible. However, the closer we get to expiration, the gamma also picks up, and the gamma tells us how quickly the options are going to change for every change in the price of the stock. When I say the gamma picks up, that means that those options, the P&L of that option position is going to react very quickly to changes in stock price. That's okay for us as long as we get a directional move in our favor. Because I think this market is at such a strong extreme on the upside, I think after we come back from the long holiday weekend, this coming weekend, I think there's a tremendous opportunity next week to get that pullback on some of these tech names. I think it's going to happen sooner rather than later. I don't need to go out 40 days to sell this call spread because I think the move to the downside is going to come much faster than that. I think it's going to come within the next week or so. By selling those weekly options with 14 days left here, if I open them up, those are going to allow me to book a profit faster, take advantage of the higher time decay, and that matches my outlook for the stock. So what I was looking at is taking a look at selling the 285, 287.5 call spread. So I right-clicked on the 285 call. I went to sell, and I selected vertical. And that brought up an order down at the bottom. You can see that I'm selling the 285 call and I'm buying the 287.5 call to make it a risk-defined trade. Right now it's trading for around 90 cents mid-price. Let's say I get filled at 90 cents. Let me bring up that order confirmation box. A lot of times people get intimidated by selling options. Well, you don't have to. This is a vertical spread, so it's a fully risk-defined trade. If everything goes against me, I know what my maximum loss is right up front. I feel much better about that. I'm collecting 90 cents or $90 per spread. That's the most I can make on the trade. So if Nvidia falls out of bed and makes a $20 move to the downside, the most I can make on this trade is $90, which at initial glance doesn't seem like a big profit, right? The beauty here is take a look at my max loss. The most I can lose on this trade, regardless of what happens, is $160. It's a pretty manageable amount of risk. If I come in and take a look at just buying a put option, if I buy an in-the-money put option, I'm talking about potentially $800 to $1,000. I'm able to lower that cost all the way down to $160 by utilizing the short call spread. So pretty significant savings. Now some of you also might be noticing, why do I want to risk 160 to make 90? That doesn't make sense. Why am I risking more to make less? Here's why I'm willing to accept that ratio. When I sell a credit spread, I've got 5 ways of making money on the trade, and here's how we do it. My break-even point on this trade is at 285.90, and that's calculated by taking my short call strike, the 285 call that I'm selling. I'm adding in the 90 cents that I'm collecting to put the trade on. That gives me the break-even at 285.90. I don't care if Nvidia moves up, down, or sideways. As long as price action stays below that level, I can make money. The current price of the stock's at 281. I can be wrong by almost $5. It can move to the upside by $5, and I can still make money. That takes a tremendous amount of pressure off needing to be right on timing, needing to be right on the directional move on the stock. It sets us up for a higher probability of success. So again, up, down, or sideways, as long as it stays below that break-even point, there's 3 ways of making money. I also make money from time decay adding up. So every day that passes, I make money from the time decay, and I make money from the volatility decreasing. So there's the 5 ways of making money that I have on the trade. Gives me a much higher probability of success when compared to just buying the outright put. However, I have a limited profit potential. So it just depends on how much risk you feel comfortable taking. I like selling the call spread here because I'm not certain on the timing of the trade. I'm not certain that Nvidia is going to move to the downside from day one. By selling the call spread, it doesn't need to. If we just kind of sit and chop sideways a little bit, I can still make money from that type of a position. Right, so again, the trade of the week is selling the 285, 287.5 call spread. We're collecting 90 cents or $90 per spread. We are going to manage this trade over the next 2 weeks. We're going to look to close out of the position if I can close it out and keep 50 to 75% of whatever I collect to put the trade on. So if I collect 90 cents here, if I can buy this thing back for between 22 and 45 cents, that's an acceptable range. So anytime over the next 2 weeks, if I can close it out between that range, I will do so. And that will give me a really nice profit. This is such a powerful trade that a lot of people miss out on because everybody gets so enamored with the long calls, long puts, and they're exciting. There's a lot of profit potential there. But the market's not always making those big moves. In a period right now where the market is very, very dull, all it's doing is grinding higher every single day, I don't want to try to force those long calls and long puts to work. I would much rather give myself a higher probability of success, give myself 5 different ways of making money on the trade. And when you start to combine these different trade types, over time, I will have some long calls and long puts. I'll have some vertical spreads like we're looking at here. And that's going to give me more consistency in my returns over time. It's not a very risky trade. Don't be intimidated by this trade. The most I can lose on this position is $160. So if I am dead wrong, I lose 160 bucks. That's actually a much safer position than just buying the outright call or put. So it's actually a very safe trade. I use these trades all the time, and we've had a really nice success rate here over the last number of years. If you have any questions on this trade, if you're going to take it and you're just curious as to how to manage it over the next couple weeks, feel free to email me directly. Mike@netpicks.com is the email, or you can just leave a comment here inside of the blog, and we'll certainly get back with you right away. All right, so hopefully you have a chance to take this trade and track it over the next few weeks. I'm going to go ahead and wrap this video up here. Enjoy your long holiday weekend, everybody, and we'll be back with you next week for our next trade of the week.